Welcome to the deep dive. Today we're cutting through the noise, really digging into Intuit's latest financials.
Yeah, we've got the numbers right here. Q4, full fiscal year 2025 results, plus their outlook for 2026.
So we're going deep on what these earnings and, importantly, the forward guidance actually mean.
Especially with all the talk about AI, right? We want to see how that's playing out in their strategy and results.
Okay, let's unpack this. Intuit, TurboTax, QuickBooks, Credit Karma, Mailchimp, they just announced results for the fiscal year 2025, which ended July 31st.
And while the headline is pretty strong growth overall.
How strong are we talking?
Okay, so full year total revenue, $18.8 billion. That's up 16% compared to last year.
16% on that scale is definitely significant.
It is, and interestingly, the fourth quarter was even stronger. Revenue jumped 20% in Q4 alone, reaching $3.8 billion.
So momentum seemed to build towards the end of the year.
It looks that way, yeah. Suggests things were really clicking across the board.
Okay, what about profitability? Did that keep pace?
It did, yeah. If you look at GAAP operating income, that's the standard accounting measure, it grew a really robust 36%, $4.9 billion for the full year.
36%, wow. And non-GAAP, sometimes that gives a clearer picture of the core operations.
All right, and the non-GAAP operating income was also up nicely, 18%, hitting $7.6 billion.
So both measures showing healthy profit growth and earnings per share.
Similar story there. GAAP EPS was up 31% to $13.60. Non-GAAP EPS grew 19% to $20.15.
So for you listening, those non-GAAP numbers, stripping out certain items, show a really solid underlying business performance. 19% growth there is quite good.
Definitely. And the CEO, Goodarzi, he called the year exceptional.
I bet he did.
He specifically mentioned their virtual team of AI agents and AI-enabled human experts as key drivers.
There's the AI angle again. So he's directly crediting AI for powering success.
That's what he said, yeah, for both consumers and small businesses. It really makes you wonder, though, how much of this is the AI buzz and how much is just, solid execution?
That's the key question, isn't it? Did the CFO, Sandeep Aujla, echo that?
He did. He talked about outstanding execution and specifically called out breakthrough adoption in assisted tax. Think TurboTax Live and these transformative AI agents across their business platform.
So leadership is really pushing the AI narrative hard. They see it as central to these strong results.
Seems like it. It's not just a side project for them, it's framed as fundamental.
Okay, so if we want to understand this better, we need to look at where the growth came from, right? Which parts of the business were pulling the weight.
Exactly. Let's connect it to the bigger picture and break down the segments.
All right. How did the Global Business Solutions Group, that's QuickBooks mainly, how did they do?
They had a good year. Revenue grew 16% overall, reaching $11.1 billion.
Solid.
And within that, the online ecosystem, QuickBooks Online, payroll, payments that grew 20% to $8.3 billion.
Okay, 20% online growth. That's strong.
But here's a really interesting wrinkle. If you take Mailchimp out of that online ecosystem number, the growth jumps to 25%.
Wow, okay. So Mailchimp is actually dragging that growth rate down.
It seems so. The CFO actually called Mailchimp a near-term drag on growth.
That's quite direct. They acquired Mailchimp back in 2021, right? Sounds like the integration or performance isn't quite where they hoped yet.
Exactly. It highlights the challenge of integrating acquisitions, especially one like Mailchimp, which is a bit different from their core financial products. They say they have initiatives to improve it by year-end.
But it's definitely something investors will be watching closely. A significant acquisition that's currently underperforming the rest of the online business.
Precisely. It's a key detail behind that overall 20% number.
Okay, let's switch over to the consumer side then. The consumer group TurboTax. How did that fare?
Revenue there grew 10% for the year, reaching $4.9 billion.
10%, okay.
But the real standout was TurboTax Live. You know, the service where you get help from a tax expert.
Yeah.
Its revenue soared, up 47%.
47%, that's huge.
It is, and TurboTax Live now makes up 41% of the entire consumer group's revenue.
Wow, so that assisted tech-enabled service is becoming a massive part of their tax business. Did the customer base grow too?
It did. TurboTax Live customers were up 24%. Strong growth there.
Okay, so people are definitely opting for that extra help.
But there's another nuance here, kind of important strategically.
Go on.
While TurboTax Live customers surged, the total number of TurboTax units filed, including the do-it-yourself versions, actually declined by 2%.
Declined. So fewer people use TurboTax overall, but more use the expensive live version.
Exactly. And Intuit says this was deliberate. They were yielding share with lower average revenue per return customers.
Ah, okay. So for you listening, this means they intentionally let go of some lower-paying customers
Yeah.
to focus on the higher-value ones, specifically those using TurboTax Live.
Precisely. It's a strategic shift, prioritizing higher revenue per customer, likely leveraging that AI-assisted model over just maximizing the total number of users. Less volume, more value.
That's a significant strategy change. Really interesting. Okay, what about Credit Karma? How did that perform?
Credit Karma had a very strong year. Revenue grew 32% to $2.3 billion.
32%. Where did that growth come from?
Mostly from strength in personal loans, credit cards, and auto insurance referrals on their platform.
So it's really diversifying their revenue streams outside of just tax and accounting software.
Definitely. It shows that acquisition is contributing significantly to growth.
Now, there's also a big structural change happening, right? Something about how they're organizing these businesses.
Yes, this is really important for understanding their future reporting. Effective August 1st, so basically starting fiscal 2026,
Okay.
they've combined the consumer group, TurboTax, Credit Karma, and their ProTax group, software for tax professionals, into one single segment just called consumer.
So TurboTax, Credit Karma, and ProTax all rolled into one big consumer bucket from now on.
That's right. They say it simplifies reporting.
Okay, simplification can be good, but does it make it harder to see how each individual piece, like Credit Karma, is doing?
That's the potential downside, yes. It raises questions about transparency. While it streamlines things, you might lose some visibility into the specific performance drivers and potential weaknesses within that larger segment.
So analysts and investors will need to rely more on commentary around the numbers, maybe.
Exactly. You'll have to read between the lines a bit more, perhaps, to understand the health of, say, Credit Karma versus TurboTax within that combined figure.
Got it. Okay, so that covers the past year's performance and the structural changes. Let's talk future. The guidance for fiscal 2026. This is always huge for the stock.
Absolutely. So for the full fiscal year 2026, they're projecting revenue between roughly $21 billion and $21.2 billion.
Okay, what kind of growth does that represent?
That implies growth of about 12 to 13% year over year.
12 to 13%. Still solid growth, though a bit slower than the 16% they just delivered for 2025.
Correct. A slight deceleration, but still double-digit growth. And for non-GAAP earnings per share, they're forecasting $22.98 to $23.18.
Which translates to?
That's about 14 to 15% growth in non-GAAP EPS. So earnings growing slightly faster than revenue.
Okay, that's the full year? What about the immediate next quarter, Q1 of 26?
For Q1, they expect revenue growth of around 14 to 15%.
So starting the year slightly stronger than the full year average projection.
Yes. And non-GAAP EPS for Q1 is projected between $3.05 and $3.12.
All right, so how did the market react to all this? Strong Q4 beat, solid full year results, guidance that seems pretty decent.
Well, this is where it gets interesting. The full-year guidance was pretty much in line with what analysts were expecting.
Okay.
Some reports highlighted that the Q1 revenue growth forecast, that 14-15%, was actually a little below what Wall Street was looking for.
A slight miss on the near-term revenue outlook.
Seems like it, and guess what got blamed?
Let me guess. Mailchimp.
Bingo. Again, Mailchimp performance apparently tempering that Q1 expectation slightly.
So that near-term drag is expected to continue into the start of fiscal 26.
Looks that way. However, you also have to remember, Intuit often guides conservatively. They have a history of setting the bar relatively low and then beating it.
Right, the classic under-promise, over-deliver strategy. So maybe the market should know that.
You'd think so, but the immediate reaction wasn't great. Despite the strong Q4 beat and mostly inline full-year guidance, the stock dropped.
How much?
More than 5% in after-hours trading right after the announcement.
Ouch. So the market focused on that slight Q1 revenue guide miss, perhaps, or maybe something broader.
It's likely a mix, maybe disappointment about Mailchimp, maybe the slight deceleration in growth, or maybe it's just broader concerns about software valuations, especially with all the uncertainty around AI's real impact versus the hype.
Yeah, that makes sense. The market might be saying, okay, you're talking a big game on AI, but show us even more growth, or we're not sure the current valuation holds up.
Exactly. Even though some analysts, like Siti Panigrahi at Mizuho, still call Intuit a top pick and an AI winner because of things like Intuit Assist.
The market's immediate vote was cautious.
It seems so. And Intuit is moving forward with AI integration. They just raised prices for QuickBooks Online and payroll last month, explicitly citing the value added by new AI features.
So they're charging more for AI, banking on its value. The strategy is clear, but the market reaction suggests maybe some uncertainty about the payoff or the timeline.
Or perhaps just a general cooling towards tech stocks after a strong run. It's complex.
Okay, so wrapping this up, we've seen Intuit post really strong numbers for fiscal 2025. Good revenue growth, strong profit growth, driven by key areas like QuickBooks Online and especially Credit Karma and TurboTax Live.
Yeah, and a clear, aggressive push into integrating AI across the platform is central to their narrative and future plans.
Looking ahead, they're guiding for solid double-digit growth in fiscal 2026, though maybe not quite as fast as 2025, and they're dealing with the Mailchimp integration challenge.
Plus, that big internal reorganization, combining consumer, Credit Karma, and ProTax into one segment.
Right. So this deep dive shows a company performing well now, but also making big strategic bets on AI and restructuring to drive future growth.
It's a fascinating balance of strong current execution and ambitious future vision.
So here's something for you, the listener, to think about. Intuit is an established giant, making bold moves, betting heavily on AI, changing pricing, reorganizing internally. How might their experience serve as a model or maybe a warning for other big companies trying to navigate these huge tech shifts and changing customer needs?
Yeah, is this the playbook for legacy tech adapting? Or are there hidden risks in moving this fast? It's definitely a key question as we watch how the whole fintech landscape evolves.